Hello, ladies and gentlemen. This is Harry Brelsford, founder of SMB Nation, coming to you live from Bainbridge Island, just outside Seattle, on what is kind of because it's a summer Thursday. So I appreciate your time today for our weekly webinar for a couple of reasons. One is, as the stock market continues to set new highs, we're all pretty busy right now. That's what I'm hearing. People are busy. They're happy busy. The other thing is, competing for your time is vacation time and the lovely late July, August time frame. So whichever malady afflicts you, I sure appreciate your time joining us for an hour of what I think will be one of our best webinars in quite some time. With that said, a little bit of housekeeping. So if you need to smoke a cigarette, go outside and go 25 feet away from the doors. The washrooms are down the hall. Wait a minute, I'm not doing live training. But we do need you to use the chat feature. We do need you to use the chat feature to ask your questions. And my anticipation is today we'll have a large number of questions. If everybody could keep it on mute, unless you are the presenter, appreciate that. So we have just as clear a conversation as possible. You'll get a personal thank you email from me tomorrow with follow-up information, as well as a link to the recording of the webinar. So you can watch it, and you can watch it again, and you can pass it on to people that you know. With that said, we're also honored that this webinar has been underwritten with a very generous donation from Kroll On Track, and representing Kroll On Track today to talk about that is our own Chris Banks. So Chris, good morning. Actually, good afternoon, sir. You're out in Florida, so good afternoon, sir.
Yes, sir. Yes, I am. Good afternoon to you. I'll keep this brief. It's a pretty straightforward message, folks. I've been working with Kroll On Track for a while, and I don't know how many of you have lost data on an external or internal hard drive where the drive itself had become corrupted, but they have a fantastic service that has helped me personally. These WD Western Digital 1 terabyte, 2 terabyte drives, Seagate external drives, these things are being bounced around in laptops and dropped downstairs and everything, and it's never been more relevant than ever to have somebody in your hip pocket that you can trust to recover these drives. So what I would ask is if you could go to Kroll.com and look up Kroll On Track, join their partner program. It doesn't cost anything to join. They'll send you an information package. Keep that in your briefcase. It may only happen to you once a year, once every 5 years. Who knows? One of your clients is going to call you up and say, you know, I've got this litigated case. My drive is bad. I need this data now. It's not a good time to start Googling for companies that do that. So if you don't have somebody else in your hip pocket, sign up for Kroll. If you do, at least take a look at their offering, and it's Kroll.com, and thank you for listening.
Well,
Kroll, by the way, Kroll.com.
One more time, sir, I stepped on you.
Kroll.com, Kroll On Track.
All right, thank you. And that's Kite Romeo. No, we don't have to go to your Coast Guard days where you would spell it out. Yeah. Chris knows all the letters. It's fun. So. With that said, thank you, Chris, and thank you to Kroll On Track for, again, being a generous underwriter of today's educational webinar on benchmarks and peer groups. Now, with no further ado, let's jump right into it. We have an expert in the peer group field with Josh Peterson. Folks, what I would encourage you to do, please put that email away. I see you out there answering emails. Put that email away. Go to LinkedIn. Go to LinkedIn and look up Josh's background, and you'll see that he's been involved with peer groups as long, if not longer, than anyone else in the SMB sector. So, Josh, please, sir, let's have fun. Let's get going.
All right, very good. Harry, thank you. Chris, thank you. So we're going to go through a couple things today. We're going to go through benchmarking. You know, I'm going to give you 8 metrics, and we're also going to talk about peer groups and how to leverage these numbers in your peer group environment. Whether you belong to an existing peer group, demand these numbers from your group, and if you choose to explore the SMB Nation peer groups, we'd sure be thrilled with that. So we've got the benchmarking your business, go it alone, or leverage the power of a group. 8 metrics to which you must pay attention. So I was on the phone with Heather a minute ago, and I had that say, 8 metrics you must pay attention to, and she was like, are you really going to end that with a preposition? So we had to scramble to say, to which you must pay attention. So I think that reads a lot better. So let's go forward here. I'm going to give you a little bit of a background here on who I am. And we'll take up as little as time as possible here. I'm a management consultant. I've only worked with IT solution providers. I've been doing it for about 10 years now. The number one goal is to grow their profitability. Okay. With the company that I work with, Bering, McKinley, we do accounting services. We do direct one-on-one consulting. We work with your PSA. We work with your RMM tool. We work with your accounting package. And most importantly, through SMB Nation, we do peer groups. And we've got peer groups for service managers. We've got peer groups for sales managers. We've got peer groups for owners. And most importantly, we've got peer groups for salespeople. We developed these peer groups so that salespeople would have a place to go. A lot of you have salespeople out there that are living on an island. They do not have anyone in the organization to bond with and connect with. Our peer groups allow these folks to get together twice a year, build a network of accountability.
Josh, I resemble that remark. Watch it.
You resemble that remark? Okay.
I'm on an island. Okay, continue.
It's a horrible island to be on as a salesperson, to be, with your 1 to 15 or 1 to 5 or 1 to 10 ratio where you're outnumbered by service people and owners. Being the only salesperson is a tough place to be. So really explore getting your folks into a sales peer group. And I promise that is the end of the selling on this entire webcast. So that's me. Handsome, dashing fellow right there. Let's go on. So we've got the 8 metrics to which you must pay attention. And let's jump right in. Now, there's a couple rules here today, all right? I love a webcast because we can talk to a lot of people all around the place. Ask your questions as we go, okay? Don't get off this thing and say, I didn't understand what he was talking about. He went too fast. That didn't make sense. Shame on you. Ask your questions now. You can type into that thing. Do it. Number 1 metric. When you're sitting in that peer group, yes, sir.
Josh,
yes, sir.
If you don't mind, we already have one. So
all right.
This is cool. Love your style. So we have it's a very simple question, but the gentleman is asking, will the slide deck be available to attendees? Josh, that's a good question. You don't really have, think about it. Your slide deck may be proprietary, and I understand that. Yep. The question's on the table if the deck will be available, and we can send that out Friday, but let me know. Let me know where you're at on that.
I'll tell you what, my number 1 goal in the world is to get these 8 benchmarks, and I got about 15 other. I want them out in the world. I want everyone to have these things. So you can have this slide deck. It's ugly as sin, but it's all yours, brother, all right? So you can have it.
Thank you.
Okay. So let's jump right in here. So you're supposed to ask questions, so ask questions. Don't just stand there crazy and be confused, all right? And stop typing and pay attention. So number 1, 55% service department gross profitability. And I'll tell you what, I get angry as I'll get out when I talk to owners, and even more when I talk to service managers, and they have no clue what this number is. All you got to do, tell me your service revenue, and tell me all your service expenses. How much do you pay in salaries? How much do you pay in bonuses? How much do you pay for a portion of your PSA tool? How much do you pay in mileage reimbursement? Calculate those. Calculate your service revenue, subtract it, and now you got your service department gross profitability. Figure that number out. And I'm going to tell you what, if you can't do that while we're sitting here on this phone by opening up your QuickBooks, then your chart of accounts is a mess, and you really need to call me or call somebody or go yell at your bookkeeper or email me, and I'll send you the chart of accounts I want you to use. You should be able to calculate that number within 5 minutes of opening up your QuickBooks. So if you've never done it, do it now and ask a question and tell us what it is, and we'll talk about it for a second. All right? The number 1 hindrance to achieving that 55% gross profitability is not hitting the 33% mark for service salaries against service revenue. Okay? And don't even say, oh, I'm at 34%, I'm okay. I'm at 35%, I'm okay. No, you're not. All right? If you're above 33%, you're going to be hurting. If you're one of my guys who was in that $500,000 or $700,000 a year business, this is even more critical because you don't have a service manager today, or maybe you don't have a dispatcher. you need to be hitting that 33% someday with a manager and a dispatcher. So this tells me a lot about your rates. This tells me a lot about your utilization. This tells me a lot about your effective hourly rates. So I need 33% to be your maximum service salaries compared to service revenue if we're going to have a prayer of hitting 55% service department gross profitability. All right? All of this drives down to hitting a net profit number. And if I'm telling you, if you don't have 55% to work with right off the top from your service department, you're not going to hit that 8.5% without something else suffering in the business. Okay, that's our first benchmark. And in your group, you're going to see, how do I compare to my peers? How does that flow through? So when you sit next to a guy and he's at 62%, you can say, oh, that's why he's got $150,000 in his bank account, and that's why I'm struggling to make payroll this week, because I don't even have a service department lined up yet. Okay. Any questions on that? Okay. Hopefully some percentage of you.
Oh, Josh,
yes, yeah.
Josh, this is from Jennifer Whitlock. By the way, the first question was from George Cabanting. George, thank you very much. Excuse me. The second one is from Jennifer Whitlock. Jennifer asked, is salary expense fully burdened?
Hi, Jennifer. I know you. It's very good to see you here. I want that thing to be inclusive of my payroll taxes. So when I'm doing my 33%, I'm not going to have the payroll taxes, but I am going to have my payroll taxes in my 55% service department gross profitability number. So those things that the service manager can control, such as payroll, let's have those in the 55%. Okay, so the loaded costs of the department are in there, but not necessarily to the individual service salaries. So health insurance for the guys, not necessarily, because our service manager can't control that. Okay? Let's move on. And Jennifer, email me and we can talk about that a little further.
Oops, Josh,
yes,
not
sir.
so fast. Hang on.
Not so fast.
I have to expand the chat window. There's so much chatter. Man, I feel like the NSA trying to monitor everybody's phone calls and stuff. All right, come on, chat window. Let's go over to monitor 2. Let's put you over here. Elongate. Oh, my. Benton is asking, where did the 55% number come from?
Chris, that came from me. That's where. All right. We need to have something. All right. So this is a very standard gross profit number for a service delivery across all organizations. And where it really comes from is working backwards. If we say we want a 10% net profit number, we start with that. And we have to work backwards and say, what can I afford to spend on the various areas of my business to lead me to a 10% net profit number? So if you work through my benchmarks, it all leads to that number. So 55% over the last 12 years, I've measured to make sure that it's achievable. So I could say you need to have an 80% service department gross profitability to hit your number. And then no one would ever hit it, and then we'd say that's unrealistic. But over the years, measured against this with thousands of clients and companies. So it's come from working backwards from our goal of a net profit number of 10%.
Finally, Josh, the next question on the table is, does service salary include benefits and overhead? Maybe you've already answered that. Does service salary include benefits and overhead?
It does not include overhead because that's a net number. So gross is just the cost of goods sold. Net is when we start talking about the overhead. Benefits, no. It doesn't include 401k and it doesn't include health because our service manager can't necessarily control that, so we put that down in the G&A section of the P&L.
Very cool. All right, please continue.
Right, saying these are phenomenal questions. Thank you, guys. All right, let's go to our next one. Now, this one, I try to, like I tell everyone when I do this one, I try to keep my blood pressure and I'm glad we can't do a raise of hands here. because this is agreement gross profitability. This is where we ask the question, do you know how profitable your managed services contracts are? And I can sit in a room with 100 people, 70 people, and I'm going to get a smattering of hands. Way too few hands, because then I ask the next question. Do you have a PSA? Are you using Connect Wise Tiger Paw AutoTask? Then all the hands shoot up. Okay? All of those guys have some version of a report that can get this to you. And you need to set your PSA up correctly in each one of those to be able to get an accurate number. But I need my agreement gross profitability to be over 60%. And all I'm doing, again, is taking all my agreement revenue, subtracting out my labor costs and my licensing costs, and then dividing again by agreement revenue. This takes a lot of time if you don't have your PSA set up, and of course we can help you set that up, but if you don't have your PSA set up, you're not going to be able to trust that report. And in some of the PSAs, it's a lot harder to get than others, but you got to demand that your PSA provide this report for you and that it's accurate. Okay, so 60% if we want to make better than break fix type of profit. Because if I'm running a managed service provider and I can't get AGP over 60%, I literally might as well go back to break fix, which I'm going to tell you, some of my most profitable clients don't have a dime of recurring revenue. They do nothing but break fix. They'll take all those people that you kicked out because they wouldn't sign a contract, and they do break fix all day long. But don't get me wrong, I love managed services, but I don't love it if you're not over 60% GP on your agreements. Okay, and I'm going to tell you, the very best service managers live and die. Look, I took the effort to put it in blue. They live and die by this report. Okay? They look at it monthly, and my hardcores look at this thing weekly. They kick that report out into an Excel spreadsheet, and they are constantly monitoring it because they're establishing budgets. How many hours can I afford to put into this contract? Okay? That's what they're asking themselves. I collect $1,000 a month for this, this managed services contract. I can put about 15 hours in, let's just say. If I'm putting in more than 15 hours, I'm not going to make it. So I did one of two things. I underpriced my agreement, or I'm over-servicing it, and don't get all excited because it's over-servicing like it's a good thing. You're over-servicing it because you suck and you're not doing a good job of creating that network and actually diagnosing what's wrong with it. You just go in there and act like a break fix with a prepaid block of time. Okay, so my guys that have high agreement gross profitability are the ones that have invested in their RMM tool and have really set up the automation and really provided a nice, clean managed services offering. So look at this number. Do it right now. Tell us what it is. All right? Any questions on this one?
Hang on, Josh. Let me look. Josh, we're clear on questions. Please continue.
All right. Thank you. Effective hourly rate. This is one that it's not a new thing. It's 100 years old, this idea of effective hourly rate. It's probably 1,000,000 years old. Let me explain the concept, and then we'll go into the 3 ways that you can calculate it. There's 1,000,000 more, but here's the 3 that really apply to us. Effective hourly rate is this. If I agree to paint your house for $100, if I paint it in 1 hour, I made $100 per hour. If it took me 4 hours to paint it, I made $25 an hour. To which you may say, big deal, you got $100, who cares? Well, in fact, I do care, because if I can paint the house in 1 hour, that means I can paint 8 more houses that day and make $800. So I need to know my effective hourly rate in everything that I do. And if I have any salespeople on here, calculate your effective hourly rate. How much did you make in commission on that last sale? Divide that by the number of hours that you spent on that sale. What do you want your effective hourly rate to be? Okay, I challenge you to do that. So back to this. There's 3 methods to calculate EHR. The first one is the total service revenue, all that service revenue that I collect, divided by my total service payroll hours. Okay, that's the effective hourly rate on total hours compensated. I need that to be at least greater than your rack rate, your advertised rate. You charge $150 an hour. When I take my total service revenue and divide it by total service payroll hours, I want that thing to be as much as my $150 an hour. Now, that doesn't take into any consideration utilization factor, because remember, you're in managed services, and Mabel and Kaseya and all those tough guys told you to get into managed services. Well, why don't you test it and see if it was worth your time? Get that effective hourly rate. Make sure that you're doing better than when you were break fix. Okay? My next one is the I'm scared of the real number effective hourly rate on build time. Okay? My total service revenue strictly divided by my total billable hours. Okay? That one should definitely be some multiple of your rack rate, 1.5 times, 2 times, something. So then you're just taking total service revenue, total billable hours. That one takes into account the utilization. Now the final one to look at is my total recurring revenue divided by my total service hours against the agreements. That's my agreement effective hourly rate. That's the one that should be at least double your rack rate. Now, I've walked into a lot of businesses that are 3 times, 3.5 times their rack rate on their total recurring revenue divided by their total service hours against agreements. Those guys have figured out their RMM tool. Those guys have figured out how to maximize their price on their agreements, and they are doing it. Sadly, however, most people, when I do this, they are 70%, 60%, even 80% at a high of their rack rate. And that's very sad to me. That's very, very sad to me to watch a guy sign a new contract. We go back and look at that contract 4 months later, 5 months later, and bang, they're getting $80 an hour, $60 an hour. Okay. Now, if I sit one-on-one in your office and talk to you about this, you got no frame of reference. When I get you sitting next to 9 of your peers, and you say, wow, that guy who I thought was kind of a goofball on the other side of the room, we did his numbers, his effective hourly rate is 4 times mine, and it's 2.5 times his rack rate. Let me go figure out what he's doing. Because you can listen to me all day long. It doesn't matter. You got to listen to your peers and sit with your peers and hear where they're struggling and how they're doing it. And if you're struggling, get some help from these guys. People are willing to help. Now, the other nice thing about the peer group, we all go to trade shows. We go to ConnectWise. We go to SMB Nation. Everybody wants to tell you the good. Everyone has a lot of free advice for you. Well, let's make sure we're taking advice from the right people. Let's sit in the same room. Make sure that we're validating this great advice that you have for us as peers. And who's got a question about effective hourly rate?
Let me see, Josh, folks. Use that chat feature. The last question we had was from Peter Hirschfeld. So, folks, going once, twice, 3 times on that topic.
All right,
Josh,
very good.
Let's continue.
Okey-doke. All right, sales and marketing budget. We're just going to follow the dime on a dollar principle. 10% of your revenue can go towards sales and marketing. 10%. You have a $500,000 a year company, you should be spending about $50,000 a year. If you're a $1 million company, $100,000 a year. I want the vast proportion of that to go to sales and salaries. I'm sorry, sales, salaries, and commissions, rather. I want most of that to go towards salespeople. I want a much smaller percentage to go towards marketing for 2 reasons. And I love you guys all. You guys are smart people, and you do a wonderful job at everything you do. But our industry, historically, has squandered money on marketing and advertising. It's not our strong suit. It's where we dump money and never get a return. So I really want to limit my dollars there. Our industry tends to work best with sales, referrals, getting feet on the street. That's where I see companies make that growth from 500,000 to $1 million, or $1 million to $2 million, $2 million to $5 million. They're not doing it strictly on marketing and advertising. In fact, I couldn't even begin to imagine how many millions of dollars get squandered on advertising in our industry that provide no return. So I want that number low for two reasons. One, I don't think we use that money wisely. I'd rather see it go towards the sales staff. And two, there's a lot of dollars out there from your vendors. I want to see you using their dollars for your marketing and advertising campaigns. Use their dollars to potentially get the phone to ring or get that brand awareness out there. Use people to get out there and sell. Now, you have a decision on this. The decision is, do I base my 10% on today's revenue or on the projected revenue as a result of these efforts? I'm a $1 million company. My research tells me that I should be able to grow to $1.3 million this year. Okay? I'm gonna go for it. I'm gonna spend $130,000 instead of $100,000. Measure it quarterly. Monthly is too much fluctuation, but true up every quarter to say how far off of my projected spend am I, but go for that dime on the dollar. Okay? Most of us are not spending anywhere near 10%. We're spending 2 and 3%. The others are spending 15, 16, 17%, and that's okay too. Remember, all of my numbers are going towards that 10% net operating profit, that EBITDA number. So that's where these numbers come from. Okay, let's go on to the next one. My AR aging report. When I work with a client, if you've heard me talk about this topic before, I always say it the same way. First step, when I work with a new client, do not do anything else. I go right to the AR aging report because that tells me two things, how good your service is and what your clients think about you to some degree. If I go in there and your AR has greater than 10% over 60 days, I know you have a problem. I know your clients probably don't like you. I know that your billing is maybe screwed up. I wish that was just the case. But it's really because your clients aren't thrilled with the service you're giving. You're too afraid to get out there and get the money from them, right? And then you just don't have good accounting basics down. So over 10% or 10% or greater in your AR, you got a problem. It tells your clients don't respect your services. Over 90 days tells me you don't respect your services. Now, I've sat in hundreds and hundreds of offices across the table with the owner, with this report printed out, and I go right through it, and I say, you've got 17%, you've got 25%. And the first thing they do, and they think they're doing the right thing, yeah, but. I hate that phrase, yeah, but. Yeah, but this guy always pays, he just pays really late. Oh, yeah, but that one, we never really finished the project. I need to send somebody out there. Yeah, but this one's never going to pay. They're jerks. Okay? Blah, 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 yawn, yawn, yawn. Don't let it get to 90 days. Set your terms, send statements every month, and make collection phone calls. And number one, give good service. Do a good job. People will pay their bills if you do a good job and if you respect your services and the services that your staff provides. AR is not just because people refuse to pay because they're jerks. They don't pay because they don't like you. They don't pay because they're not happy with their service. And bring me your AR report and we'll say, all right, go ahead and call that guy. He owes you for the last 120 days, he owes you $5,000. Give him a call. You're going to be afraid to call him, I guarantee it, because you know the guy's going to cuss you out and say, what do you call me for this money for? I told you your service sucked and I'm not going to pay the bill. Okay? Don't let it get to that point. When we get to one day before your terms, 15 days, 30-day terms, make a phone call and say, hey, your bill is due tomorrow. Is there any reason we shouldn't expect to have a payment? Oh, my gosh, you're not happy. I just discovered it. Let's figure out what we can do.
Josh?
Yes, sir.
Let's see. Sonny Batalara, longtime customer of SMB Nation. He says, "Heck, Josh, you broke my bubble, man." I guess you're speaking the truth. We have an internal comment from SMB Nation staff. I think some of our audience members are mesmerized. That's in a kind way. All right, please continue, Josh.
Sonny, we're going to rebuild that bubble. I'm sorry that it got bursted, but it's going to get rebuilt because you're doing better than you think, my man. All right, AR aging report. Get on this. Print it today. Get your dang staff in front of it and say, why do we have over 60 days? And don't take any nonsense. All right, days sales outstanding, okay, DSO. This is another one that ties into your AR report, obviously, and this is the one I love, love, love getting in front of a peer group with, because here we can uncover a lot of process problems, a lot of client satisfaction problems, and a lot of just regular process problems. This is, on average, how long does it take people to pay your bill? Okay? I want it less than 30 days for cash flow purposes. The world we live in is a 30-day world. Our bills come in every month. We got to pay them every month. People have to pay our bill every month as well. If we're going greater than 30 days, your cash flow is going to be out of whack. So I can tell you this. You're not going to believe it. Get in a peer group with 10 other companies, and then you're going to hear it. Make your terms 15 days or less. Make your terms be on the spot. Make your terms be direct deposit. If I had the nerve, I would make this DSO that it needs to be less than 5 days. And I'd get a big round of applause from my good friend Carl Palachuk, who, if we ran this on his MSP, would be 0. Everybody pays on the spot through ACH, not even credit card, ACH, so that he doesn't have much in terms of processing fees. Okay, but we got to get that money, and we got to get it now. So get it below 15 days. If you're below 30, that's great, but more importantly, how closely does your DSO match your payment terms? And the calculation is pretty straightforward. Your total accounts receivable divided by your total credit sales, that's anything where somebody's going to pay you off of an invoice, multiplied by the number of days in the period that you measured. And there's your DSO. Okay, do this quarterly, pay attention to it, see how it affects point 4, the one we just looked at. This is all about cash flow. You tell me you got cash flow problems, I'm going to go to your DSO, and I'm going to hopefully watch you, smack your forehead with your palm and say, duh, this is what I need to do to fix this. But if you give crappy service, we got nothing to talk about. Your DSO is going to be horrible. Your AR is going to be over 60 days, or over 90 days, over 10%. If you give bad service, all of this is moot. Why I look at this when I engage with a company, or why I look at this when I work with a new peer group, is that this is the lie detector right here. You can tell me about all your great processes, all the wonderful ways you do things, but if these last 2 numbers are out of whack, fail. You're not doing what you say you're doing because your clients aren't paying your bills. All right. If there's no questions, we're moving on. We're getting down to numbers 2 and 1 here, so get excited.
We're clear. We're clear. Go.
All right. This is a new one. I just put this one on the other day. I love this one. I'm not going to do a great job of explaining it, so I want you to all Google it, get to Investopedia. This is an amazing one. It's your working capital ratio. Okay? Your current assets divided by your current liabilities. This is just looking at, do we have enough assets to cover what we currently owe? What an easy one. Crack open that balance sheet. Do this number. If you're less than 1 as your ratio, you're in trouble. You're decreasing sales and you're increasing levels of debt, you're in bad shape. Now, to look at this in a vacuum and just look at it today gives you no frame of reference. You've got to look at this over a period of time. Now, you can do that by just setting your balance sheet date, because the balance sheet is a snapshot in time. Go back every 4 months. Just change it, do the math, write it down, and say, what's been the trend in our working capital ratio? Okay, because we got to see, are we growing at a rate that does not include new debt? Because anyone can grow by throwing money at it and borrowing money. We can increase our assets that way, no problem. What we need is an increase in current assets, which includes physical assets, but more importantly includes our AR and our cash on hand. Okay. Anyone can grow some of those things, by putting debt towards it. It's the good managers, the good owners that don't incur debt to do this. And you all know, I hope some of you don't know because you haven't experienced it, our businesses do not handle debt well at all. and it's an easy thing to hide. It's an easy thing to ignore. Do this working capital ratio, and there's no ignoring it. If you have debt, you're struggling, and it's hard. And I need you to get in front of a peer group so you can say, what are the characteristics of a company with a strong working capital ratio? What does that afford them in the rest of their business and the decisions they can make? When you have a poor working capital ratio, your decisions are limited. And when your decisions are limited, you are not making good decisions.
Josh, what I would enter into this conversation is I totally agree with you on this slide, but I think, I sometimes make strategic decisions to take on long-term debt for an acquisition or strategic purposes. So that's a planned activity, basically so take on debt to make an investment. It's great when investments go well. It's not as fun when investments don't go as well. But still, it's a rational decision, right? It's not like I went and saw the banker out of weakness. Hopefully not. It was more that, hey, we want to do A, B, C, D, and I'm prepared. In our community, you typically have to sign personally for the debt. That's been my experience in the small business realm. Now, maybe maybe we'll get big enough to where it becomes corporate debt, but
right. Yeah.
Let's just say it's both. It's both corporate and personal. But I just wanted to enter that into the conversation because there is such a thing as sort of a planned drawdown on a line of credit or taking on long-term debt. Is that fair?
Absolutely, and I think you bring up a good point because some of these words are not, super clear. On the working capital ratio, it's really talking about current, those assets that are generating some sort of usefulness in 30 to 90 days, current liabilities, those debts that are due now, that are due in the next 90 to 120 days. So you're not taking into account those long-term strategic debts. Okay, so it's really your current and your current. And of course, in fact, I have a former team grow to one of the biggest, all with debt, and that was a risk that paid off very beautifully for them. So, absolutely, we can leverage debt to grow our businesses for sure. Just make sure that you're watching your ratios, that you're not getting yourself over your head. Okay. Let's go to number one.
Sir. Oh, you know what?
Right.
Sorry, we got a question from George Cabanting again. George says, do you do this calculation monthly off of QuickBooks or use an annual number?
This is really something that you want to look at a minimum of quarterly, and really monthly is beautiful because this is your working capital. This is your day-to-day stuff. So it's going to change every time you pay your bills and receive your invoices. So absolutely, you're going to look at this thing monthly. There is no button to click in QuickBooks to get you this. Now, I will tell you, and I promise you I'm not going to go salesy on you, so I'm not going to do it, but our tool, which you upload your connects directly to your QuickBooks 24 hours a day, it has that number ready for you on a heartbeat. It's right there staring at you, and it shows you your trend over the trailing 12 months. So it's right there. No calculations necessary. So get a tool like that or talk to me and we'll get you in that tool. You can afford it, I guarantee it. All right? So the answer is monthly. Annual doesn't do a whole get it monthly. Final right here. EBITDA, earnings, interest, taxes, depreciation, amortization. EBITDA, also known as net operating profit. This is the profit from the operations of your company. That's why we don't look at the taxes you pay or the assets you're depreciating or the interest that you've received or paid. This is from the reason I'm in business, how much profit did I generate? Okay? As it says right there, that says nothing to do with the money in your pocket because you still got to cover those things that are after interest, taxes, depreciation, and amortization. But this is, did I run a good, profitable business? Did it throw off 10%? You got to get 10%. If you're not getting 10%, you got to figure out what's going wrong. And if you're living in the 2 and 3% world, you're living in a world where you can't even imagine how it could be 10%, and you got to sit next to a guy in a peer group who's doing 15, 20, 26%, and say, how are you doing it? I'm looking at your numbers. You've shared your numbers with me. I can do it too. Okay, but if you're struggling, you know, you can hire a consultant, you can do whatever you want, but until you sit right next to a guy and validate that he's doing what you want to do, it's not going to hit home. Okay, 10% is the minimum. In our peer groups, that is what we are constantly driving home to people, is you need to get to that mark, because that's when life starts looking really rewarding. That is when you start building a business that is sellable. That is when you start building a business that allows you to not work 60 hours a week. That is when you start building a business that allows you to put a layer of management in your business. Okay, so 10% is the target. The calculation is very, very easy. What's my net profit divided by my total revenue? And all of those other metrics, whether it's service department gross profitability, sales expenses to total revenue, all of those lead to my net profit of 10%. Now, I don't have a slide for this one. I'll just say it out loud, and we can talk later about it if you want. There's one other cost center called your general administrative, your G&A, that needs a certain percentage as well. And I like to use somewhere between 10 and 13%. I've seen some people go up as much as 15%. I don't like that. I think that's giving yourself a break. It's hard to hit 10 to 13% when you're at $500,000, because those general administrative resources it takes to run a $500,000 company will pretty much be the same when you're $1 million and $2 million. So I don't want to give yourself an out and start spending more before you get the revenue target, because it's just going to drive that net profit number down. But if you do your G&A calculation, all those expenses divided by your total revenue, and you're in the 20s or 30s, two things are happening. One, you're not categorizing things correctly in your QuickBooks, or you're spending way too much money on goofy stuff, and that's why you're limiting growth. So there's our EBITDA number. Those are the 8 keys. That's it. Let's go to our final slide. Any questions at this point?
No more questions, but before you do, I want people to stay to the end, because we have picked a winner for the BlackBerry Z10 phone. So how cool is that? How BlackBerry is that? That's kind of our new phrase. How BlackBerry is that? And guys, I make you suffer. I have the name in front of me, and I can read it. And Josh, I won't read it, because I want people to stay to the end and ask questions. And it's a combination of signups and you attended live. So, Josh, great stuff. Continue, please.
Okay, final slide. So these are my rules on here, okay? And I changed some of the rules because some of my rules are kind of mean, but I'm just going to make them nice today. So evaluate your financials in accrual mode, because that talks about how you're operating month to month. Of course, you're going to file your taxes in cash mode. Okay, but as you're running these reports and your balance sheet and your P&L and your AR and all that good stuff, do it in accrual mode. Okay, many of these benchmarks require you to run calculations. Make it a priority. You have time to do all the other goofy stuff. You have time to sit there and BS with your buddies about what solution they should be putting in and talking about gigabytes and terabytes and all that nonsense. None of that crap matters. All right? What really matters as an owner here is, do I know the health of my company? Make time to run these calculations, or even more smartly, give us a call. We'll put you in our tool. Our tool can do most of this for you, and you're going to have it at a moment's notice in a beautiful format that's live for you 24/7. Okay? Weekly financial meetings with your bookkeeper. Weekly, whether it's an outsourced bookkeeper or whether it's an in-house person, sit down formally, sign your checks, confirm deposits, identify what collection calls need to be made, look at your bank balances. Do that weekly. All right? I'm going to skip down and contrast that with monthly P&L and balance sheet meetings. So you're meeting weekly to make sure that everything's getting done, but monthly you're having your P&L and balance sheet meeting. Know what you're looking for. I always look at my P&L, means nothing. That's garbage. Okay? You don't know what you're looking for. You don't have a goal in mind as you're looking at it. Your monthly P&L and balance sheet meeting should have a purpose to it. How did we compare it to last month? How did we compare it to last year at this time? How do we compare to the rest of the quarter? What does the quarter look like? Okay? And again, use a tool like we have, and it makes this beautiful. It makes it graphic. It's right there for you, and we'll walk you through it. So it's in real nice shape for you. You got to have a monthly P&L meeting, because as you get ready for your peer group, you got to know your numbers cold, because your 9 other peers in that room are going to be busting your chops if you don't know it, because everyone's putting the same effort into knowing their numbers so they can help each other. Okay? If you have poor DSO, if you have poor AR, look at my solution here. Okay? Invoicing occurs 3 times a month, twice for T&M, once for recurring. You want to do daily. I love it. If what you're doing works for you, and you have good AR numbers, and you have a good DSO, there's nothing to change. But if you don't like what you're doing, if you're doing it ad hoc, if you're doing it all at the end of the month and it's driving you crazy, on the 7th and 21st, do your T&M. On the 14th, do your recurring for the next month, for the following month. Okay. Obviously, a little self-serving on this one, but there's lots of options out there. Invest in a method of tracking your trends. Trailing 12 months is a great indicator of what's coming next for you. You got to see, where have we been? What trend are we on? How is my revenue growing relative to my expenses? How is my cash on hand changing relative to my growth? You got to have an answer for that. You got to see what's going on in the past to determine what's happening next. Okay? And the final one, regular comparison with your peers leads to greater probability of you living by these numbers. I can tell you this stuff. I've given this similar presentation more times than I can possibly remember, and I know that 99% of you sit here and say, you know what, I found something in here that I can use. 1 thing, 10 things. But when you get back in your day-to-day life, there's no one to hold you accountable. Get with your peers, sit in a group with them a couple times a year, build your network, and compare. At least know that a couple times a year you're going to have to show these numbers, and somebody's watching out for you as well. That's all I got for you. Thank you very much.
Josh?
Yes, sir.
Yep. Yeah, absolutely. We have questions. A couple of housekeeping items, folks. We have the SMB Nation peer groups. Please make yourself aware of the SMB Nation peer groups, smbnation.com, pick peer groups, announced a week ago, literally a week ago. And if you are at the ASCII event right now in New Jersey, Atlantic City, New Jersey, stop by the SMB Nation booth and see Regina Ciardello, who's working the booth literally right now. She'll be in the booth about another hour before the trade show hall closes. And again, that's out at Atlantic City at Caesars in New Jersey for the ASCII group event. Regina's already reported, by the way, Josh, really robust crowd. She said about 180 people. So, yeah, my compliments. That's a handsome audience for the one-day ASCII event going on live right now. If you're not there, there's not enough time to drive there. Oh well. Again, a huge shout out to the sponsor today that underwrote this webinar with Kroll On Track. And you can certainly learn more at the SMB Nation site about the sponsor. But again, Kroll On Track for a really interesting take on disaster recovery. We will announce the Z10 BlackBerry Z10 winner in just a minute. We have a couple questions, Josh. Sunny Badalera is, first of all, let me take this one straight up. What is the peer group URL again? From George Cabanting. George, please go to smbnation.com. That's smbnation.com. And on the menu options at the top, should be the 5th or 6th one over. Hang on, I'm online. Let me go just there myself. 5th or 6th one over. 1, 2, 3, 4, 5, 6, 7th. 7th over. Peer groups on the top menu line. Sunny Badalera asked, for Harry, what would an MSP startup cost be as of today, say year 1? I think I understand. I think the question is really for Josh, but I'll take a stab at it. MSP startup cost for year 1. You know, in my SMB Consulting Best Practices book that I wrote some time ago, though it's an evergreen book because it's a business book, so it stands the test of time. But I wrote that about a decade ago. And I said, your cost your cost back then to start an SMB consultancy is very simple. It's 1 year's salary from your prior job. And what I'm talking about is you need a year of, and I was talking about the small SMB partner working for himself, okay, so understand where I'm coming from. Josh will have a different answer. But quite frankly, I was talking about my friend Tim Lonnie down in Houston, who accepted an early retirement offer from American Express, and he used that money. Tim, thank you for your service. Here's your check. Don't let the door hit you on the way out. He took his large check and put himself in business, and now he's a thriving MSP in 3 states and 4 cities. So 1 year's salary is my simpleton response. Josh, how would you answer that in the real world? MSP first-year cost.
You know what? I think you gave a great real-world answer. So if I'm bootstrapping and just going at it, 1 year salary, I love that answer. If I have some resources, I'm going to look at how many salespeople can I afford, or actually how much will 2 to 3 salespeople cost me? What are those salaries? Call it $30,000 a piece. There's $100,000. I got to have a tool that's going to cost me about another $6,000. I'm looking at $100,000 when it's all said and done to get the tools I need, to get my sales force in place, and have some money to have some techs do the work. Okay,
excellent.
So I'm thinking $100,000.
Which shouldn't be too far away from 1 year's salary, with all due respect to our segment. It shouldn't be that far off. Now, folks, if you're one of my dear friends that just got riffed at Microsoft Redmond last week with the reorg, give me a call. I'll buy you a cup of coffee, and we'll turn you into an MSP within 1 year. Little bit of inside Seattle humor there. If you don't live here, you might not know what I'm talking about. Let's move on. We have, just to confirm, you have the slides available. Yes. We have, can you mention, about follow-up email? Lots of people want, okay, thank you, Heather. Heather from the control room sent a private to me. Can you mention about sending the slide deck in the follow-up email? Absolutely, Heather. Let's make that part of tomorrow's webinar follow-up meeting bright and early at 7:30 a.m. Folks, this is your last chance for true, honest, analytical questions. We have a couple minutes left. While you're formulating those questions, and Heather screens them for appropriateness, we don't censor. Just kidding. But while Heather forwards them to me, you know what? Take a look at smbnation.com. Poke over to peer groups. See what we're up to. We're fired up. We're fired up. We think we brought together the expertise of Josh Peterson and his team, along with our Josh, I don't know. It's always hard to talk about yourself. I guess I would say hopefully the respect we've earned in the community over 14 years. You know, we get up every morning and earn it again. Let me tell you, I start every day unemployed. I've always felt that.
Gosh, I never thought of it like that. That's scary but true.
Start every day unemployed, guys. It's midday, and I need a nap. But I'll take a walk instead. This is your last call for questions. We don't seem to have more questions coming in. Heather, could you just shoot me a private if there are no more questions? As I'm getting fired up to announce the winner of the BlackBerry Z10. And if you got today's newsletter, I think most people on this list do get today's newsletter. You'll see the intro video. It was the telecom newsletter this morning, and the intro video is myself with my son with another episode of How BlackBerry Is That. So I think you'll like it. We had a little bit of fun with that. With that said, let me scroll down. We definitely had a lot of activity today. We do have a question. What is the best strategy for going from a one-man shop to growth? Andrew Ganga. Let's see. Let's take that. What's the best strategy going from a one-man shop to growth? Quickly, Josh. We only have a minute left. Give it your best shot, sir.
All right. So Andrew, first of all, email me. You see my email on there. Email me that question, but I'll give a general answer. Go get a salesperson. Get somebody out there selling 8 hours a day, every single day. Fill your pipeline. If you can afford to pay them a little bit of a base salary so you have their attention, do it. But the best strategy is to double your sales efforts and get out there and make it rain.
There you go, sir. You said it best. So the winner attending on today's webinar is David Ferrara. David Ferrara. I believe I know his dad. That name rings a bell. Out of Boston. So David Ferrara. Yes, the email address. It's the son of the father, which makes sense. It usually works that way, that you are a son of a father. So with that basic biology lesson, folks, let's bring it to a close. We are at the top of the hour. Thank you for taking time out of your day, because the stock markets are at all-time highs in the background on CNBC. Plus, it's vacation time, so to get any of your time is just an honor and a pleasure and a joy. Have a great day. We'll see you next week, and you'll get an email from myself and Josh tomorrow with the deck and a little follow-up note. Thank you very much. Goodbye.
Thank you.